So what we are going to do in this lecture now is just reinforce some core concepts that we sort of did in the example from the last class. Okay, one core point is this cost of fixed assets. When we talk about spending, say, $30,000 on our building and equipment and so on, is that an actual cash expense? But will accountants show that as an expense in the income statement? What will they show? They will show an asset. Okay, but how is that? It is a real expense. So how is that expense actually shown on the books, on the statement? Actually, what accountants are doing is something actually sensible. What they are saying is, let's say that they get an asset that's being used for 10 years. Okay, so the thinking in accounting is that we have this asset for 10 years. We'll use this asset to generate sales for 10 years. So since we are generating sales / revenue for 10 years, let us also recognize the expense over 10 years. Okay, so that's really what depreciation is. What depreciation is, you are spreading the expense out over the life or the useful life of the asset. Is that a sensible thing to do? It is a sensible thing to do, so accountants are justified. What's the principle called in accounting? This is your matching principle. You are matching the expense with the revenue that is being generated because of that expense. So it is a sensible thing. But it messes up the cash flow, so we need to figure out the cash flow. Okay, now the depreciation is a non-cash expense. If it is non-cash expense, why not just completely ignore depreciation? Okay, in this calculation over here, imagine all the complication in, you had all this depreciation related stuff because of which you had to do all this. Why not just ignore depreciation altogether, Omar? That's not Mahin, right? Or Haneen. How does that impact the cash flow? So next to Haneen. But so that's my point. It's featuring very, it's in the middle of this calculation over here. My question was, why not do this whole spreadsheet without any mention of depreciation? Because as you pointed out, it's non-cash. If it is non-cash, then why use it in coming up with cash? What's the objective of this entire? The question is very simple. It is, we've all agreed that depreciation is a non-cash expense. Okay, so if depreciation is a non-cash expense, and we are trying over here to come up with our cash flow every year. Okay, so in this analysis, why are we considering depreciation given that it's a non-cash expense? Exactly. So the reason we do depreciation is to figure out what the tax will be, what the tax savings will be. Is tax a real cash flow? Yes. Tax is a real cash flow. So in order to figure out what our tax will be, we need to have depreciation in our calculation. Once we figured out what the tax is, then we have NOPAT, so that's net operating profit after tax, then we add back depreciation. If we had never considered depreciation in the analysis, Isa, what would have happened? Yeah, exactly. Yeah, so assuming a profitable business, you would have given out more tax, so your calculation of the tax of your cash flow would be wrong. Okay, so that's the point here. Okay, so another side remark, if you buy equipment for 20,000 and then it costs another 5,000 to ship it to your location, set it up and get it running, what amount do you show as an asset? 20,000 or 25,000? You show that entire amount as an asset, and that simplistically becomes the depreciable basis. What does depreciable basis mean? Yeah, so that's the amount in your books which you will start depreciating. Okay, so just a subtle point that you need to know. Okay, I've already made this point. Depreciation shelters income from taxation. It's not a cash outflow, therefore we add it back to NOPAT when estimating a project's cash flow. Okay, what about changes in net operating working capital? What is net operating working capital? Osama? Next. Exactly. So does in the current assets should we include cash? No, actually, why are we doing all this exercise? We are doing it to figure out how much cash is coming in or going out. So very simplistically, your net, why do we use the word net? Basit, why do we use net? Net operating working capital. Next, what's the net usually means what? The difference. Whenever you see the word net, it means that something is being netted out or subtracted. Okay, when you say net income, just have you ever thought about this? Every time you hear the word net, that means stuff is being subtracted. Okay, so when you say net operating working capital, next to Basit is Hussain. What's being subtracted in the net operating working capital? This is, so in the context of working capital, what's the inflows, outflows? So we are saying, what is working capital? Examples? Exactly. So the classic example of working capital is inventory. Actually, it is all your current assets like inventory, receivables.
Won't cash be part of it?
Yeah. So the point is that from an accounting perspective, if somebody asks you a question, what are current assets, then answer is cash is there, marketable securities are there. Okay. Prepaid expenses might be there. So there are all these things from an accounting perspective. But in this context, when we talk about operating working capital, we are looking at your current assets that are used for your operations. But since our objective here is coming up with changes in cash, we do not count cash. Cash is what we are calculating how much cash is being generated. So the simple thing to think of is working capital on the asset side is your receivables and your inventory. So if inventory is going up, yeah, that is typically not operating. Okay, that's not part of your regular operations. That's why marketable securities effectively is like cash. Okay, now when inventory goes up, what's happening to your working capital? It's increasing. So is that a use of cash or source of cash? It's use of cash. Okay, now what happens? So Obed. So if inventory is going up, but in a given year you have a wonderful supplier who's saying, okay, you can take inventory and pay me later. So what's happening on the liability side? What's going up? Accounts payable is going up. So is there any net change in cash or net impact on cash if the inventory and accounts payable are both going up? No. Yeah, exactly. So in a given year, if you can get your inventory without paying cash, then your inventory is going up and your payables are going up, so there is no net impact on cash flow. What?
How do you account for people insurance?
Okay, so so this is sort of getting into a little more detail, but very briefly, the way you would account for something like say prepaid insurance and stuff like that, you could consider that just as your short-term working capital asset, and an increase in that means a use of cash. So practically the way this sort of exercise would be done is, if you look back at the example, the simplest thing is to calculate your working capital minus all the cash. So you figure out your net working capital at the end of the year. You look at your net working capital at the beginning of the year. Let's say the number increased by 100. What does that mean? That means there was a use of cash of 100. And the way you can remember this is, say that, okay, my only working capital is inventory, and if inventory goes up by 100, that means that I used up cash. So in your calculations you will show that as a use of cash, which means you are subtracting. Okay, what about, okay, so the whole point is explained here. For expansion projects, typically net operating working capital is positive, therefore this is an outflow. If it happens to be negative, like when is it negative? A classic example would be at the end of the project. You have your inventory sitting there. What do you do at the end of a project? You sell it off. What will be the change in working capital? Working capital will come down. When that comes down, what does that do? That generates cash. The assumption being it's coming down because you are selling the inventory for cash. Okay. Towards the end of the project, inventories used will not be replaced and receivables will be collected. So that's the assumption. So all your inventory is sold off, all your receivables are collected. So is that good cash flow? Yeah, that's money coming in. Okay. Next point, interest expenses are not deducted. So if you go back and look at all this stuff, did we subtract interest anywhere? We did not. Okay, why not? Yeah, so one answer is free cash flow is available, but now here is another addition to that. Think of it this way. Okay, now interest expense is the cost of debt, right? Have you thought of it that way? You borrow money, and what's the cost of borrowing money? The interest that you pay. Is that interest expense or the cost of debt built, if let's say that number is high, is that good or bad? That's bad, because that number is high. That means your cost of raising money is high. Now that bad stuff, where does it show up in your analysis? Where do you sort of deal with that high interest cost? Well, we just said that in the cash flow, which is we are not putting in that high interest cost. So where are we dealing with that interest cost? We are building that into cost of assets. I'm hearing all sorts of random but incorrect answers. Umar? Up till now in this... No, but here we are looking at cash flow, and in the cash flow there was no interest expense. Where that interest expense, cost of debt, in what you've learned over the last 3 weeks, where was the cost of debt? WACC, exactly. So when you have high cost of debt, what does it do to the WACC or the cost of capital? It goes up. So if you have a bad situation, which means high cost of debt, then you have a high WACC. Okay. Now when you have a high WACC, what does that do to the present value of your future cash flows? It decreases. Is that good or bad? Bad. So it's, high cost of debt is bad. That makes high WACC, which is bad. High WACC makes low NPV, which is bad. So notice that the high cost of debt is built into the WACC, and hence our analysis, which let's do the NPV analysis. So the high cost of debt will result in a higher WACC, which will result in a lower NPV. So that's where we are dealing with the cost of debt. If we also put in the interest cost in our cash flows, then that would be double, dealing with it twice, both in the numerator. Very simplistically put, if I refer to the cash flows as the numerator and the WACC as a denominator, will that make sense? Yeah. Simplistically, as a very rough simplification, that is the case. So very roughly speaking, if you have a long-term project, you could treat it like a perpetuity. Where does the cash flow go? If you are coming up with the present value, what's the numerator? It would be the cash flows. What would be the denominator? WACC. So notice that if the WACC is high, the NPV will always be lower. So if the cost of capital is high, that automatically reduces the NPV. So do you understand, since that high cost of capital, high cost of debt is in the WACC, you don't need to deal with it in the numerator. No, we don't. I'm saying we account for it. We account for interest once in the WACC.
In the WACC, but otherwise it's done twice.
What's otherwise?
I get how it's against.
Okay. So let's discuss that after class. Okay, let me just now please come back here. So I'm just going to read out now what I have explained. So bottom line is, you need to know that interest expenses are not deducted when we come up with our cash flows. We discount a project's cash flows using WACC, which is what we just talked about. WACC is the rate of return necessary to satisfy all investors, both stockholders and debt holders, right? And subtracting the interest payment from a project's cash flows would amount to double counting the interest cost, because if you are also subtracting it from the cash flow and also increasing the WACC, that would be double counting. So we simply account for the interest cost in the WACC. Okay, So cash flow versus accounting income, this we've already discussed. Accountants measure income available to stockholders, not to all investors. What does this mean? Saad, everybody else also pay attention because I might pick you. Not sure. Actually, accountants measure I'm asking you to explain this first bullet point. What does this mean? Somebody else. So who's not?
So they use it as a pay profit and loss expense. They consider that
What's it? WAC is an investor? Oh, bank, yeah. Yeah, very good. So I hope everybody here has seen some annual reports with income statement or P&L statement. So what's the bottom line in the P&L statement? Is it bottom line is EBIT? EBIT is a middle line somewhere. Yeah, the bottom line is the net income. So that net income is from whose perspective? Shareholder perspective, because you arrive at that net income after having. So when accountants create their P&L, they do subtract interest because their perspective is the shareholder. Now when you look at your net income, and all of you have seen a P&L, that net income is the money available to both preferred and common shareholders, or just common? Yeah, it's both. You actually need to look at that carefully. If the statement is net income available for common shareholders, that means that the preferred dividend is subtracted and then we are at that number. But if you just see net income, that normally means it's the income available to both. So who will be paid from the net income? First the preferred, they get preference in terms of dividend payments, and then after that common shareholders, and then the rest is retained. So that's the point here. Accountants measure income available to stockholders, not to all investors. Therefore accountants deduct the interest expense. So you notice this. So an accountant is going to deduct the interest expense in his regular income statement. But when we are doing a cash flow analysis from the perspective of all investors, and we are discounting at WAC, then we as financial people do not subtract the interest from the cash flow. We only deal with the interest and the cost of equity in the WAC. Okay, sunk costs. Okay, so somebody, so Umar, example of sunk cost. Not this Umar, the Umar at the back. No, as in that Umar. Okay. So if money, and in your investment decisions, should you consider sunk cost or not?
No.
But you already you have spent that money, right? So why should you not consider that in your decisions? Next, Haneen. Actually, you have next behind Umar is Javeria. Yeah, we've accounted for it. So in our decisions, we should not account for it anymore. Okay. Do you want to, next to Haneen is Serish. Next to Javeria is Serish. So what's you want to build on? Nothing to add. Mahin, you have something to add? Okay. Exactly. So let me give you an example just to hammer this in. I think we are all on the right track. So a couple of years ago, okay, please. A couple of years ago, I invested some money in an apartment complex that was about to be started in Ajman. Okay. So I sent some money there. Now, turns out that some bad things happened, and you know that building started being constructed, but now the rate of construction is extremely slow. Okay, so I made some payment upfront. Now I need to make monthly payments. I need to continue to make monthly payments. They are due. So the question that I should ask, I should think about whether I want to continue spending money on this. Let's say I've already spent $100,000. Now in my decision of whether or not to continue putting money into this project, from my perspective it's a project, right? I'm making some investments and I hope to get a return in the future. So the $100,000 that I've already spent, should I say that, look, I have already spent so much money, so I should just keep spending? Or should I ignore the 100,000 in my decision of whether or not to continue investing in this? I should ignore. Exactly. So the point is that is a sunk cost. But having said that, how often have you heard something like, इतने पैसे इस पे खर्च कर दिए अब थोड़ी सी और कर दें? So what is fundamentally flawed with that statement? Exactly. So whatever has been spent is sunk. Now your decision in the for what to do in the future should not be based on sunk cost. However, now let's say that I made this investment for my company, and the company is now evaluating my performance, my ability to make good investments and so on. So if my performance is being evaluated by taking, let's say the way my company evaluates performance is it looks at all the investments I've made and then calculates the return on those investments, and then figures out what my average return was. So if I'm being evaluated based on the return that I'm generating from different investments, then should we consider the sunk cost?
Yes.
Yeah. So if
the money you have wasted.
exactly, so that should show up. Okay. So the bottom line is this: if we are evaluating the performance, coming up with return measures, then we should consider. Okay. No, exactly. So this is a good point, and this is a classic mindset that 100,000 has. So this is actually really classic, and a lot of people do this. Okay, so I have already spent 100,000. Okay, now so then the thought process is कि इतने पैसे खर्च कर दिए तो अब और भी कर दो. Okay, the point here is my analysis should now be how much more money do I need to spend. Okay, let's say that these chapel builders in Ajman, they keep saying that आपने हर महीने हमें $1,000 भेजने, and then I evaluate that I can keep paying $1,000, but the amount of money I still need to give them is say 50,000, and even when this apartment is built, nobody is going to buy it. Okay, so I can put in another 40,000, but at the end of 5 years that will only be worth zero. So should I keep putting in because I've already put in $1 million? No. On the other hand, if I can, let's say the present value of my future contribution is 40,000, and I anticipate that I can sell the building for 60,000, then should I keep going? I should keep going. Here is the core question. So some people might say don't go because you've already spent the 100, but that is already gone. So the way you look at it is, if let's say that my additional cost is 40 and I can sell the apartment for 60. Okay, should I go for it or not, given that I've already spent 100? No, so now, so the NPV moving forward is good, better than any other option. So the way you think of it is this: if I spend the additional 40 and can sell it for 60, what is my overall loss?
Minimizing losses.
I am minimizing my losses. So if I continue to put in 40 and I can sell it for, how much did I say, 60 or 60? So what is my overall loss considering the 100 before? So it is 140 is and 60, so my loss is 80. If I stop right now and say, look, it's a loss, so I should not do anything, then what's my loss? Then my loss is 100. What's better, a loss of 100 or a loss of 80? So this is called cutting your losses.
It's not sure that you get 60,000
in this simplistic example, let's say I'm sure. Okay, so as long as I'll get more, so you notice that the decision has been made based on now moving forward. Okay, so here is another example from your book. Okay, I think my example was better. Okay, yeah. So loudly. So.
But I will run by you first if you could.
Well, you can't ignore the other 40 people in the class.
Okay, perhaps bonds and equities, and where the reliability of the returns The rating on bonds.
Okay, this is an after class discussion. We're off on a. But
The research gone into that would be a sunk cost, right?
Yes.
Essentially.
yeah.
But that's a viable sunk cost. That's something that I don't know if it's viable is the right word.
Oh, okay, we can talk about it after class. Okay, so I hope the core point of a sunk cost everybody has understood. Okay, now Basit, what's an opportunity cost?
The opportunity.
So give me an example in a business context. So cost of
Best available option.
yeah, what you are repeating the stuff that you've learnt in an earlier course, which is fine. Okay, but in a practical context, give me some examples of sunk cost. So, yeah, green T-shirt name, Hassan. So opportunity cost. Okay, so that's a good. Okay, you're mixing things up. I think like one way of putting it is you're a company and you have some money. Either you can use that money to expand, or you can say invest the money somewhere else. So in this context, what's the opportunity cost?
If you would have invested in something.
Yeah, the return that you could get somewhere else. That opportunity cost is, you're right. How has that opportunity cost already been discussed and accounted for in what we've discussed so far? So the opportunity cost that he just talked about, where did we deal with that? Next to, yeah, we dealt with that in back. That is the, yeah, so retained earnings, we don't explicitly have to pay anyone for it, but the cost is associated with it. That's the cost of retained earnings. Let me give you, so Sarish, can you think of another example of what we are talking about? So you need to pay attention. Next, Javeria. So everybody in this class is, on the same track right now. Now think of a business. Okay, let's say that your uncle gifts you a shop in the forum. Okay, so he's a great uncle, wonderful guy, gives you this shop for free. Okay, and let's say that if you hadn't received this shop for free, you would have to pay a 60,000 rupee a month rent for that shop. Okay, now you are excited, you have this shop for free. Okay, and you, rather than go down this corporate world, you decide to have your own freedom, have your own business. So you start a small, in this shop you say, okay, I will sell Apple products. Okay, so you get an Apple franchise and you have your little Apple store in the forum. Okay, and now in your analysis of whether you are doing a good job or not, whether you are actually creating value, should you consider the 60,000 rent, which actually you are not paying?
Yes.
Why should you consider that if you've not? It's a benefit. Well, it is a benefit. So, but are you paying that 60,000 to anyone? Is the 60,000 an opportunity cost?
What are you saying?
So in your analysis, in your NPV analysis, let's say that you project your cash flows. Okay, you project your cash flows and you figure out, is this a positive, can this be modeled as a project? Your shop project, it is a project. So when you let's say that you want to utilize what you are learning over here and you do an NPV analysis. Let's say that you could also do another project, so you want to see which would be higher NPV. So the very simple question is, in the NPV analysis, would you consider the 60,000 somewhere, even though you're not paying it? How many people think yes? A few. How many people think no? Okay, is everybody clear about the question? Okay. So question is very straightforward. Everybody's understood the picture, right? You got a gift from your uncle, shopped in the forum. The going rent for that shop is 60,000. But are you paying that? No, it's a gift, so you have it for free. Now, if you are to calculate the NPV of the shop project, okay, to do NPV, how do you do NPV? You look at all the future cash flows. Let's say that you have your cost of capital that's given 12%. You discount at 12%. The question is, in your cash flows, should you consider the 60,000 somewhere in there? Okay. So there is a hung jury over here. The answer is, okay, before I give you the answer, let me give you one more piece of information. Let's say that you can generate profits and cash flow, ignoring the 60,000, of 55,000 every month, which happens to be a shade better than your starting salary that you might get. Okay, so you can generate 55,000 every month. Would you jump up and down with joy that I can generate 55,000 every month net after covering all your electricity bills and paying the guy who works for you and the cleaner and all that? You are generating net 55k every month. Let's say that all that I'm talking about here is a perpetuity.
Yes.
Is it a good project?
If we don't pay rent forever, then
But the rent is free, right?
Yeah, the rent is free, the shop is free.
then is it free forever or is it like limited time?
In my simple example, it's free forever.
Then we're not considering.
Huh? How many people think this is a good deal? Huh? What do you think, Saad? Exactly. So this actually is bad because you could do nothing, just rent it out for 60. Wouldn't that be more sensible? You can sit at home and watch Pakistan lose every single day, but let the shop and get your rent. So the point is this: you should consider opportunity costs. Bilkul. So this is a negative NPV project. So the point is this: what is the purpose of all this work that we've been doing over the last few weeks? The purpose is to evaluate what projects are good and what projects should not be accepted. So now listen to this very carefully. Bottom line is, opportunity costs, even though they are not explicit costs, need to be considered in your cash flow analysis. In the example that I just gave you, the 60,000 should be considered, and that will correctly make the project a negative NPV project. Because the sensible thing for you to do here is not do this business and just rent the shop out for 60,000 and then spend your money somewhere else. Okay. Now here, that was my example. There is a not so good example from the book that you can also read. Okay, next. What are externalities? Yes. What are externalities? Third party. So, something that you don't have control over. Okay. Now, again, look, what I am trying to do here is, the one issue that I see is you learn these concepts, but you don't see the practical utilization of those concepts. So when we talk about an externality, give me a practical. Imagine that you are at a company like Pepsi, okay, and let's say that you are in a somewhat senior position and you are evaluating whether to launch a new beverage business. All right. So you've come up the marketing track, and now you are the product. You are potentially the product manager for this new beverage business that Pepsi is considering. In this context, some smart IBA recent graduate pikes up and talks about externality, but doesn't quite know what he's talking about. Okay, so just using good words without knowing exactly what they mean. Okay, does that sound familiar? Okay, so now you need to clarify what is an externality in the context of what I've just spoken about. Okay, so Nabia, what's an externality?
I think it would be that
On the right track. So what are we talking about in cash flows here?
Yeah.
So what's the what not?
Sales.
Exactly. So the externality here is, if I launch this new XYZ beverage, okay, what is the impact of this new beverage on the sales of my existing soft drinks? Right, so they will go down. Okay, now the question is this: let's say that you are projecting, and again, numbers I'm going to give are simple numbers to illustrate the concept. Let's say that you project that for this new business, the sales will be 1 million every month. Okay, but the impact on other Pepsi products is minus 10 million every month. Okay, now in your analysis of whether or not to go forward with this business, should you use 100,000 every month or 90,000 every month? You should use 90,000 every month. So bottom line is that you do consider externalities in your cash flow analysis. Okay, so that's the core point. The example that I just gave you is a negative externality. What is the cruel sounding term for a negative externality? Cannibalism. Can you also have a positive externality?
Yes.
For example?
You're launching a complementary product.
Exactly. So you might be launching Lay's chips with the thought that when people eat Lay's chips, they might want to buy more Pepsi. So in your analysis of whether or not to launch this chips business, should you consider the positive impact on other product lines?
Yes.
You should. So that is a positive externality. Core point is that we consider externalities when we talk about, when we evaluate projects. Okay, we just have 5 more minutes. I want to wrap up this core point, and then after that you can stay back and ask as many questions as you want. Okay, replacement projects. In a replacement project, we are replacing one product with another, and in the analysis of replacement projects, you need to consider what's called the incremental cash flows. What do I mean? And obviously the timing of cash flows is important. So let's look at a simple example. So you have an initial investment of 100,000. Okay, so the point here is you are considering replacing a clunky old machine that is expensive to maintain with a new machine that will help generate more sales and will be less expensive. So how do you figure out what to do with whether to go for this machine or not? If you do a standalone analysis with the new machine, you say that the initial investment is 100,000 and then the sales generated is 40,000. You subtract operating costs and then you say that for 5 years I'll have a net cash flow of 26,000, assuming a WACC of 10% and that this will happen for 5 years. You are smart enough, you can calculate the NPV. Let's say the NPV is negative 1440 and the IRR is 9.4. So would you go for this project or not? No. But would this analysis be appropriate, or should we look at incremental cash flows? What is happening is you are buying this new machine, but you are selling an old machine. When you buy the machine for 100, you sell the old machine for 40. So what's the incremental cash flow? 60. The sales revenues with the new machine are 15,000 higher. So should you consider 40,000 or the 15,000 higher? You should consider 15,000 higher. Similarly, operating costs are better by 5,000, so you consider 5,000. So all the items we just talked about, if you consider only the incremental numbers, then what happens to NPV and IRR? Then the numbers are decent. So the question is, in evaluating whether to do this replacement project, do you use the incremental numbers or the absolute numbers for a given project? You look at incremental numbers. So that's the bottom line. In any project, you look at the incremental benefit and the incremental cost and make decisions based on incremental cash flows. The incremental initial investment is negative. So when you actually do your NPV analysis, how would you come up with the NPV of this incremental project? What's cash flow 0? At time 0 it's minus 60, and then for 5 years you will have a 16,800. Okay. So that is it in terms of the planned lecture for today. Those who have questions can just stay back and we can go over questions.